Good morning. Welcome to Stock Market Today for Thursday, September 24th, 2020. This is your host, Dan Russo, Chief Market Strategist at Chaikin Analytics. Find me on Twitter at @DanRusso_CMT. Stock Market Today comes to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email where I get a lot of the content for this show and also give you daily stock ideas to consider that hits your inbox every trading day before the market opens. So U.S. equities were lower on Wednesday's trading with the major indices down for a fifth time in 6 sessions. All sectors were lower on the day, with energy the worst of the bunch. Treasuries were a bit weaker overall. The dollar was stronger against the major crosses once again. Gold settled down 2.1% on that dollar strength, closing below $1,900 an ounce for the first time since July 24th. WTI crude settled down 30 basis points on the day. And as we get to the desk this morning, futures are up about 10 basis points in the S&P, reversing earlier losses. Asian markets were lower overnight, with South Korea, Taiwan, China, and Hong Kong all down over 1.5%. Japan fell about 1% on the day. European equities are lower. Treasuries are mixed, with the curve flattening. The dollar is firmer against the yen and the euro. The gold rather is down 70 basis points again on that dollar strength. WTI crude is up 10 basis points to kick us off on a Thursday morning. It starts with the major averages kind of sitting around key points. The S&P 500 must hold here. It's got to hold this 32.50 area, right? So that's 323, 325 if you're looking at it in SPY terms. The risk is if we lose this area, we get a bigger decline down to the 3,000, 3050 area. And that lines up with obviously round number support at 3,000, which came into play back here in the June-July timeframe. 3050 is a key retracement level of the March through September advance. Qs can't hold 270. I think the way to frame up the Qs and the growth trade in general is constructive above 270, conservative below. For the past couple of days, we've been writing that we think it makes sense, with markets oversold, to begin to redeploy capital that may have built up as part of a risk management process. That's not to say you jump all in, you jump all out. That's to say your risk management kicks in, your cash levels build, and then you get to a level where probability starts to dictate redeploying. And I think we hit that level in Monday's trading, setting the stage for, beginning to redeploy capital. You have names that you like that have set up, start to add a little bit. That's kind of how I've been looking at it. Not full positions, adding at key levels, and then as the market stabilizes, you can then add to those positions. Small caps take the brunt of the hit, dropping further below the 150 mark for the IWM. It's long been our view that we favor large over small. So a lot to digest here, but the key takeaway is we're basically at inflection points, and the odds change based on what happens from here, right? So below 325 for SPY, odds of a decline increase. Above 325, odds of an advance increase, and you kind of adjust your portfolios accordingly. 270 is the key level for the Qs. Let's talk about the market in a minute. What are we writing about today in the note? Well, stocks come under pressure after a one-day reprieve. Breadth metrics worsen over the past week. However, short-term trend metrics near washout levels. We'll talk about what that means. I can't display it here, but I'll reference it a little bit later on in the show. Homebuilders show relative strength in the sell-off, and futures point to a slightly higher open here today. Looking at the major indices now from a power bar perspective, the Dow was down nearly 2%, and the power bar ratio took a beating. 2 bulls to 8 bears there. S&P 500 now goes negative, 86 to 128 bulls to bears after losing 2.3%. The Nas was down 3%, took the brunt of the hit yesterday along with small caps. 12 to 19 bulls to bears on the NASDAQ, 408 to 363 bulls to bears on the small caps. Flight to safety sends bonds higher, yields lower. According to the Chaikin Power Bar, small cap stocks are somewhat more bullish than large cap stocks, and the major indexes across the board are mixed. Let's take a look at the stocks, plural, of the day now. Last week, we showed you a screen where we screened for names that were starting to show weakening relative strength, starting to break down on a relative basis, with the thought being with the odds of increased volatility due to the close below 340. Those were the names that if you had them, you probably wanted to sell them. If you trade bearish, you probably wanted to look for an opportunity to take them out. The volatility picked up. The market continued lower, so hopefully that screen served you well. But today what we want to do is now look for names to consider on the long side. Should the market stabilize, right? Should the playbook that we just laid out on the major indices start to come to fruition, these names here are a good starting point for looking for long ideas. Essentially what I've done is I've screened the Russell 3000 for names that are neutral or better above our trend line, our rising long-term trend line, that have exhibited a 6-month high in both money flow persistency and relative strength persistency. So if you think of what these names are names that have been under accumulation, they've been outperforming the market, and they continue to be in uptrends that you could potentially want to take advantage of. And right away, some names like Lennar and Lowe's that jump out at me. I see Adobe and SS&C, Salesforce.com, NVIDIA, Horizon, right? These are some quality names that have likely sold off with the market that then set the stage for a potential opportunity should the market stabilize. Look at Amazon, look at PayPal, right? These are names that Apple on the list as well, along with Accenture. So, if you're thinking about doing your work and putting together a list of ideas or potential ideas, I think this is a great starting point. So save this slide and maybe use it to build a watch list of names that are potentially compelling, especially if SPY gets back above 325 and the Qs get back above 270. Let's look at our sector tracker now, movement of the major sectors over the last 5 days. Everything down, okay? Under pressure, there's no two ways about that. Tech at the top of the list is actually encouraging, right? We want to look for the areas of the market that hold up the best when the market pulls back. Remember, for the past few days now, we've been saying that we think the growth over value trade is at an inflection point where odds favor it moving higher. So we want to look at tech, obviously. I've provided a bunch of screens in my notes over the past few days that skew in that direction. Staples, healthcare, and discretionary round out the top 4. In the middle of the road, we have comms, utilities, industrials, and financials. The banks are a mess, continue to be under pressure. I think that's a key group to watch as a signal here going forward. Materials were a group we liked. They've come under pressure as commodities have come off with a rising dollar. We actually started to write about the fact that, hey, we've liked materials for a while now, but if the dollar is going to continue to rally, that view starts to come into question, right? So you can kind of see, right, the situational awareness that plays out, the if-then scenarios. You don't remain dogmatic, right? If there are data points that point you in the direction of having to change your view, you start to open your mind to that. Real estate and energy at the bottom of the list. Energy, I mean, just disaster is the only way to describe it, and it just is not getting better. So we've been pounding that table for I don't know how long. I've been pounding it so long that my fist hurts. Our industry in focus today is one we want to avoid. It's telecom services. Over the past 6 months, lagging the S&P 500 by over 13% and still has a very weak power bar ratio with 13 bears for 4 bulls to earn it a rank of number 17 of 21 subsectors. It has moved up 2 slots over the past week, but I would say who cares? Very bearish names in the group: ATEX, Antenix, Inseego, INSG, and Boingo Wireless, Wi-Fi, WIFI, all with very bearish Chaikin power gauge ratings that are members of a ETF that looks like this. I mean, this doesn't look like anything I want to touch. Bearish rating for the ETF. We have the bearish ratio here, 13-4. The trend is weak. Bearish money flow, underperforming. I mean, there's just nothing good to say about this. I mean, I try to remain open-minded to some degree, but if something is a dumpster fire, then it's a dumpster fire, and that's what this looks like to me. Closed dead on its lows yesterday, took out an interim support level. There's just nothing to like here. So I think this is a group that you avoid, or you potentially look for bearish opportunities. Let's take a look at what's trending now. Yesterday's S&P 500 movers and shakers, our gainers and losers. Nike up 8.75%. I am long Nike, long time holding for me. So Was very encouraged by the print that they put up and the action in the stock yesterday. Investors like what they heard as it related to a reorg at Western Digital. That stock higher by 6.7%. Twitter caught an upgrade and was higher by 6%. I am long Twitter. UAA probably up with Nike. Under Armour there up over 4.5%. Quanta was initiated outperform at SC Bernstein, and that sent that stock higher 2.5% in a down tape. On the loser side of the board, Albemarle down 15% as Tesla at their battery day started commenting on insourcing battery production and lithium supplies. That hit the lithium miners, including Albemarle, down 15.5%. The rest of the group here on the loser side of the board all have one thing in common. They are members of the energy sector, so down 6 to 9% respectively for APA, MPC, Valero, and PXD. So you can just kind of see the type of carnage that continues to play out in the energy complex. Let's dive into the charts. Breath gets worse. Okay, the percentage of stocks above their 200-day moving average is now at 53%, lagging lower here after those divergences that we've been calling out for the past month or so. 50 being the key level here. For those of you who follow Dave Keller, I know he was writing about this recently as well. Dave has pointed out the fact that if we get below 50%, that could potentially be an ominous sign for the market. So if we're thinking about where we stand for the S&P 500 and calibrating the odds, under 325 and a failure to regain it quickly increases the odds that we go down to the 3,000, 30, level or 300, 305 level for the SPY. Those odds get bigger if this metric drops below 50%. Start to connect the dots. Percentage of stocks in intermediate term trends above their 50-day down to 25%. Not quite washed out levels yet, but moving in that direction. Discouragingly, the advanced decline line slips below the February highs to join the index there. So now what we'll want to do is start to look for divergences to play out. Now, the one encouraging part of the breadth landscape, not shown here, I highlighted it in my note, is the percentage of stocks above their 20-day moving average, right? So short-term trend metric has fallen to about 8%. And that's getting close to levels that are washed out, close to levels that have marked interim and important lows for the S&P 500 over the past few years. So that's something to keep in mind as we're thinking about the framework, right? Regain 3250 would be important. And we'd start to look for these metrics to be improving as well. But short-term trend metric from a breadth perspective, beginning to hit washed out levels. Homebuilders actually look like a relative bright spot to me. So if I'm thinking about other areas of the market away from the growth theme where I'd be interested in potentially putting money to work, the relative strength at the bottom of the chart here in the Homebuilders is encouraging. The group is holding above its February highs, above a rising 200-day moving average, while the RSI holds bullish ranges, right, during the consolidation / sell-off here, not getting below 40. So momentum holding bullish ranges and relative strength holding up, and the group holding above the February highs leads me to believe that if we get some sort of stabilization in the market, XHB is likely to continue to be leadership, and you want to drill down on some names there. If you kind of go back to the screen that I showed you, you can see some of the home builder names on there, as well as home builder supply chain names like Lowe's. So just kind of connecting the dots again and putting it all together. And then finally, we'll look at global stocks. Global stocks are also at a key level. This is the ACWI MSCI XUS index. The relative strength is something to keep an eye on, but we're going to watch it here. That's going to wrap us up for a Thursday. Take us for a test drive. I'll be back tomorrow.